The prospect of looming Fed rate cuts has helped fuel the market's recent winning streak. The probability for a March cut is now at 85%, while cuts in May and June are fully priced in. But my next guest says the market's getting ahead of itself and will be disappointed when those cuts don't materialize. Joining me now is Bill Lee. He's chief economist at the Milken Institute. CNBC's Rick Santelli is also with us. Welcome to you both. Bill, I'll just start with you. Why the pushback?
Well, I think in order for the market to be correct, we're going to have to start seeing some weakening in the real GDP or some real fall off in the inflation rate that gets us to or below the Fed's target very quickly. Because the Fed has already programmed in 3 or 4 rate cuts going forward, but to accelerate it to this early means that something has gone wrong. Something is not in their Fed forecast, and likely the market is worrying perhaps about the weakness that's yet to come because of that tightening that we've done. One of the problems, though, is that this equity market doesn't show that. So I think that it's got to be in the very low inflation rates that the markets are anticipating. And maybe if that is a surprise, that's a good surprise.
So the only thing I'd say about that, Bill, obviously being sympathetic to that point of view, is it is possible that doing rate cuts because inflation has receded so quickly is a perfectly fine reason for doing them.
Oh, absolutely. In fact, right now, the problem is that real rates are really historically very high. It's well above 2.5%. And because the Fed has announced that it's pivoted, the long rates have come down, as Rick knows, like crazy. And right now, the real rates are down to about 1 3/4 or so on a 5-year basis. Well, that's about the right level for the Fed to have to sustain a robust recovery. In order for us to really have high real rates, we're going to have the kind of productivity growth we saw in the 90s. And that's perhaps what the markets are betting on, because NVIDIA and all the AI chip stocks are sort of hinting that we might get a burst in productivity of the sort that we saw in the 90s. And in that case, we really can have high real rates and very, very low inflation.
Right. And Rick, maybe you can refresh my memory. I'm sure someone on Twitter can. Back then, Alan Greenspan was able, I think it might have even been Yellen way back in the day. But anyway, Greenspan was able to correctly discern this productivity pickup. It's a little hard to see in real time if it's happening, but I guess the steady GDP data and steady labor market data could tell us if we're getting the good kind of disinflation.
Yeah, the issue is that nobody knows how inflation will ultimately behave. We don't know if it's linear. We don't know if it's going to have a couple of pops. And when it comes to the Fed Fund futures contract, the Fed should consider the relationship a good one. They use Fed Fund futures to discern and send out all their messages. And the relationship between the markets and Fed Fund futures and the actual activity of the Fed has been pretty much spot on. So if we're starting to see something build in futures, that means the central bank has to address it in nearby meetings, because they will not, and I underscore, they will not disappoint a market that's priced something in. They need the markets. Now, that doesn't mean you're not going to see differentiation along the yield curve. I personally think that they are going to be forced to lower rates, and I'm not so sure that forced is even the right word. But I do see that they're going to have to quell the market a little bit on expectations, or they're going to have to make sure they're in sync. There is no other way. And finally, when it comes to Fed Fund futures, the amount of horsepower built into the easing cycle is easily evident by looking at any of the contracts for next year, and especially Jan 25, because it's a clean month, as Steve Leisman and I like to say, no Fed meeting. But look at the breadth of the rally that started when rates peaked in the middle of October, and you'll see how intense the market is pricing and how much pressure it will put on the Fed to make sure the market's message is in sync with theirs.
And maybe I could put you both on the spot a little bit just in honor of looming New Year's Eve and ask about predictions or anticipations for next year. I mean, Bill, you're obviously sort of saying if we get these rate cuts, it's a weak economy, and if not, rates might be stickier than expected. But in what other ways, productivity is a good one to dwell on. In what other ways do you think the economy might surprise us?
If we have the disinflation that the markets are anticipating, if we look at like the 6-month PCE inflation, it's down at the Fed's target. If that were to continue, we've got these rate increases, and Rick's going to be absolutely right. And the messaging from the forward markets, the forward guidance that the Fed has provided to let the markets drop like that is going to be absolutely right. But if stubbornly high core inflation stays above 3% for the next 3 prints, I think we're going to see some delays in the timing of these rate cuts.